Hey, welcome back. There's a lot of fear, a lot of things going on with the banking world right now. We wanted to jump on a video and explain a little bit more about what's going on and what we're seeing out there. So, Quint, give us an update.
So we're getting a lot of questions, rightfully so, by folks out there, and we've actually had an opportunity to do a lot of media. We'll put some links below, some really good articles and interviews regarding the depths of what's going on in the banking crisis, and we're getting a lot of questions about your money. So I want to give my personal opinion, and this is opinion after everything I've read and understand that if you have a deposit at a bank underneath the FDIC insured limit of $250,000, you're fine. There's really no reason to be concerned about diversifying those deposits, taking them out, buying gold, hard assets. The FDIC is there to insure the deposits of depositors up to $250,000. Now that is per account of the individual at the bank you're at. I should say per individual at the bank you're at. So if you happen to have more than $250,000, even if it's in a checking and two savings accounts, that over and above is not insured. Now, we would always say this to anyone at any time that that's probably not wise. It would be wiser than to diversify among banks if you're above that limit. So why are we even talking about this? This is very important to understand why we're even having this dialogue. It goes back to 3 weeks ago when we started to hear that a bank in California, by now everybody knows the Silicon Valley Bank. We didn't know what it was 24 hours before then, but in very short period of time, that bank underwent a failure, was taken over by state regulators and the FDIC. Ironically, that happens more often than you'd be aware of in the United States, but it happens on a very small scale. Usually when a bank is taken over, very few, if any, of the depositors are above the limit of $250,000. So the FDIC comes in, makes the depositors whole, the bank operates no longer, and they move on. In this instance, it was a much larger bank, and because of the nature of the business of the bank, serving primarily startups that kept sizable amounts of cash at the bank. Why? Because they were using them to make payroll, develop software, hire engineers, build out offices, you name it. That bank kept those assets on hand and invested in treasuries, United States treasuries, academically known as risk-free assets. Now, this not only happened at Silicon Valley Bank, happened at another bank called Signature Bank that was ultimately also taken over by the FDIC a few short days after Silicon Valley. And the speculation is, and I say speculation because we do not know, but you can look at the stock price of many of these publicly traded banks. The speculation is they're not the only two experiencing challenges. Subsequent to that, we've also had news regarding Credit Suisse being taken under by UBS. We now have news regarding Deutsche Bank and UBS itself as potentially having some financial trouble. I will say that since the financial crisis, many European banks, UBS, Credit Suisse, Deutsche Bank, have never fully recovered. These are not surprising to the marketplace, and I believe that's why they're making headlines, but they're going away in the kind of grand scheme of things very quickly. It's not a surprise at all. Now, if you're unaware of that and you hear these headlines, it can be very scary. What is happening to sort of create further volatility in the banking sector, and oh, by the way, Logan, you'd think, if I told you all this, that the market, like the stock market, is down considerably.
Yeah,
That's not the case. No. The market is actually responding fairly well. It's been a decent month. And the reason it's responding well is what's happening in the banking sector is doing a lot of the work for the Fed. And Jerome Powell even admitted that. He said, what's happening in the banking sector is tightening credit, and it's doing what we are intending to do by raising interest rates. And that's a positive for many stocks. Now, the problem that's transpiring in the banking space, and by the time we send this to you, news could change. I just saw across the wires that Janet Yellen, head of Treasury Secretary, is having a closed-door meeting this afternoon with other Fed regulators. And so we could see a change in policy very quickly. But what the problem is right now is that the Treasury has not come out to make a statement saying that over the insured amount is going to be protected. They have said the following: we have taken measures to protect depositors and will continue to do so if it's needed. I'm paraphrasing, but that's basically what they're saying. Sadly, that's not enough. What that means, or is being interpreted by the market, is if other banks fail, we could potentially step in to shore up the depositors. Well, that's not good enough if you're a depositor and you have $1 million at a bank. You're going to be moving that money. And as that money moves, that's how a bank operates. That's their lifeline. So as that money moves, because we don't have that real affirmed backing, that money's going out of various banks and creating significant amount of pressure. Now, let me address the naysayers out there who say, oh, here we go, we're just bailing out the banks and the taxpayers are going to pay for this. Please understand, by the Treasury saying what they're saying, they're only going to calm the fears so that this money stops moving out of these banks because people aren't scared that they're going to lose their capital.
Right.
Over and above, I continue to stress this is only for people over and above, or businesses over and above the $250,000 limit. Underneath, your FDIC insured. I think it's very poor execution that the Treasury, the FDIC, is not coming out to say we are going to make sure deposits are secure,
or at least say we're going to raise the limits to a higher amount than
for
maybe
even the
250.
time being.
Right.
They've not gone ahead and done that. That's what's causing the concern in the banking space. But I wanted to just, again, I'm getting a lot of questions because obviously we're in a day and age where the more brash the headline, the more clicks, the more advertising dollars, the more downloads, you name it. And we're getting a lot of questions, ironically, nothing to do with the stock market, which is a refreshing break because the market's been doing quite well, but more about your money. I am not making any banking changes. I'm not moving out of my bank. I don't keep above the limit. I keep excess capital invested. When you are invested, you hold investment instruments, whether that's treasuries or stocks or index funds or ETFs. They're actually vehicles that you are invested in. So I have no concern personally or for clients regarding that. The only thing I'm sharing with people is if they have above the FDIC insured amount, they should consider diversifying. And that would be standard practice regardless of the environment.
Okay. I don't think we need to go much farther in there. Is there anything else you want to say?
No, that's it.
All right. You guys have a great weekend.